Hello and welcome back to The Note. You might remember earlier this year there was a fascinating academic dispute over the CAPE, the cyclically adjusted price earnings multiple, as championed by Yale University's Robert Shiller. It's been popular since he successfully used it to show that the internet bubble was ready to burst, but it's come under academic attack in recent months, and then of course the Nobel Prize decided to honour him. Where have we reached in this debate? Does the CAPE really suggest that stocks are ready to fall after a year in which US stocks have gained more than 30%? With me now to discuss this is the global market strategist for JPMorgan Asset Management here in London, Andrew Goldberg. Thanks very much for joining me. Let's start by looking at a, by now, very familiar chart. This is the cyclically adjusted PE ratio as measured by Shiller going back to 1899. Suggests there were bubbles in 29 and 2000, and it suggests stocks are badly overpriced now. What is your take on this?
Just to start, Shiller did a really smart thing here and basically recognized that earnings ebb and flow in cycles, and to smooth it out, looked at earnings over the last 10 years on average.
Yep.
So that's a smart thing. The trouble with it today is that last 10 years includes the 92% decline in earnings that we saw during the Great Recession, something that I don't think certainly is going to be repeated. And so I think what that's doing is skewing this a little bit higher than it otherwise might be. It's a little misleading. Let's just take a look at this as we have this in graphical form coming up.
So you've obviously a very, very dramatic fall of a kind that we hadn't seen before, but also a very dramatic rebound thereafter. And if we look at the 10-year moving average, this is a point Shiller himself made a few months ago. If you look at the 10-year moving average, yes, that dip in the moving average is quite startling, but it's not amazing, and you still see a picture that earnings are much higher now than they were a decade ago.
Yeah.
What's wrong with that notion of it?
There's nothing wrong with that, and that's something that, and by the way, Shiller's a brilliant economist and deserving of the prize. So he's right about that. It's just that if investors are looking at the CAPE to determine if the stock market today is in a bubble, I think they're going to find themselves a little bit misled. Earnings do tend to go up over time, and they should as companies learn how to be more efficient. Also keep in mind the economy's still got more room to grow. That should help earnings. So I'm not a raging bull on the stock market, but I would caution people, just because this one measure, the Shiller measure, shows that stocks are as much as 50% overvalued, don't put all your eggs in that particular basket.
Okay, now let's take another way of, there's another way of looking at history, which is how long markets can continue to advance once they've started. How long the momentum can carry you. So 2009, these are figures you've kindly produced. 2009 is there in the middle of the pack. In terms of the advance, it's somewhat ahead of the average already in terms of how long it's gone on. Looks as though you would argue from that it could carry on a while longer. Where do you see this? Yeah,
truth be told, if you were to actually throw out a couple of the outliers, what you would find is that this has been a pretty exceptional bull market in terms of the magnitude of the return. And the fact that it hasn't been all that long in terms of length actually tells you that the market may in fact have gotten ahead of itself a little bit, but that's okay. And one thing that I also caution people,
it's okay that the market's ahead of itself. Carry on. Yes.
Yeah, it's okay that the market's ahead of itself, because don't forget, just because the market's come a long way does not mean that it's going to go down. One thing that I always remind people, in particular our clients, valuation is a very useful tool for understanding the potential for your future returns. It's a horrible predictor historically of bear markets and corrections. Much more likely, oil price spikes, interest rate hikes by a central bank, those are what cause corrections, not PE multiples.
Okay, briefly, final 2 points as we come into 2014.
Sure.
People are worried about the possibility of a melt up. Lots of people joining in the last stage of a bull market. They're also worried about what happens if the Fed doesn't manage its message well enough and we have a really sharp tightening in the bond market. How greatly do you, those are risks in opposite directions, how do you assess them?
Yeah, the way I weigh that is ultimately the Fed and what the Fed's going to do will generally amount to noise and near-term volatility. The fact of the matter is, even if the Fed decides to taper its bond buying, the market will recognize that it's much better for the economy to be healthy and not need medicine from the Federal Reserve than it is to be dependent on the Fed's bond buying program. So what you'll see in 2014, simply a repeat of 2013 probably won't happen. the market's going to be much more constrained by earnings growth, which will be modest, and therefore I think you can get a modest to moderate melt up next year, strong single digits.
Okay, Andrew, thank you very much indeed. I think the main themes there are ones that we've heard before, and it's difficult to disagree with them. It's hard to say we're in a bubble yet. You can see the risks that we could be in a bubble before this bull market is over. It's hard to say that the market is cheap, but that doesn't mean, and probably won't mean, that stocks are about to go down.